I'll get started here. Thanks for joining us, guys. So there's kind of new faces in the new mastermind, the group coaching mastermind, and there's some old familiar faces that have joined us that were from the original mastermind, started a couple years ago. So the difference between the two is the original mastermind was a group of investors that had invested my first few deals, or and basically are like the top 5 or 10%. I kind of forget where the waterline came, but very elite investors in my opinion. Um, and the group coaching is the kind of the new program that I have now. So that's like Roger, for example, is from the older group, Dave's from the older group. But so this, I just kind of wanted to open the discussion. If you guys had any questions that you guys want to just talk openly about. I did want to talk about, I am going down to Little Rock and Huntsville potentially. We don't even have it under contract yet, but I'm thinking somewhere in the second or third week, I'm going to use my newfound freedom and go and check out some of these properties, do some due diligence, and I'm going to also check out some mobile home parks. So if you guys have the time, be looking for an email from me when I'm making that trip. And if you guys want to come along, yeah, it'd be a lot of fun just to kind of hang out. If anything, it's safer in numbers to go. And then the Belize trip is June 25th to 28th. So I worked the deal out with Darren. He's the coffee guy and cocoa guy that if my group comes, it's going to be sort of like a free field trip for you guys. Think of it like a timeshare thing, but it's a lot better, a lot more fun, a lot of cool people, and lower pressure sales. So that'll be in Belize. And let me know, I got to book the tickets for just block off the rooms for now. So if you guys can let me know here very soon, if you're just at least interested in that. And then the other mastermind that I'm kind of planning is like a wine tour, like how we did in Sonoma last year, but in Seattle. So I'm gonna go back up to Seattle, probably in Woodinville. And if you guys haven't been to Woodinville, it's not like you get on a bus and you travel 20 minutes from winery to winery. You walk 10 feet and you're at the next winery. So the people might have to cool themselves a little bit. It's definitely rapid fire. So bring some bread, some baguettes, and I know Roger will be coming out to that. That's in his backyard. So.
Do you have a date picked out for that?
I was thinking July 4th. I want to be up around Seattle, so around there. Okay. I'll talk to you.
Okay.
Maybe we can kind of coordinate it because Debbie helped me last time, and maybe you can kind of help me from up there too. Although I kind of know what's up there already.
Yeah. I'm actually moving out of the area end of May.
Okay.
So yeah, it'll be vacation for me at that time.
Cool. But yeah, I mean, I any questions you guys had that's kind of going on with me with deals or anything you guys want to discuss with the group that we got here?
Yeah, actually, I guess have you dealt with retrading and any of that kind of stuff? Regards to stuff that you found, how have you dealt with that in the past, with any of the deals you've done?
Well, I mean, with the bigger stuff, you don't retrade, right? You always have to have a good excuse why you're going to ask for a concession. I think when you sign a letter of intent, the assumption is that property is in pretty dang good shape, right? The common retrade, I wouldn't call them retrades. I call them just concessions are all right, you go and you check up all the HVACs, right? And a lot of these are 100 HVACs for some reason, and 10 of them are just they're gonna stop working in the next 6 months. Everybody knows it. So then you just go 10 times $3,000 or whatever, and you're like, well, can't you just knock off 20 grand off the price? That's fair and reasonable, and most sellers will just do that. But you got to have a good reason, right?
Yeah.
Because if you want to nickel and dime everybody, now not only is your broker not going to like you and not going to want to work with you, but so is that seller. I guess the broker relationship is more important, especially in the commercial stuff.
Yeah.
And then there's a trick where like you always make it seller paid concession, or seller, like cash at close in a way. That it's like a seller paid allowance.
Okay.
But any other questions you guys had, and anything you guys are seeing? Anybody?
Hey, Lane, listen to
Yeah.
your I just listened to your most recent podcast with the Moneyball guy. Do you actually believe what he said about the possible future of the economy? That it's going to have a second wind as opposed to going into a recession?
I actually am starting to believe that a little bit. The whole China trade thing.
Mm-hmm.
That guy's a little kooky, not gonna lie, but I mean,
Yeah.
I've been following his stuff for the last like few years, and supposedly he's got a big institutional following. Like he's the real deal.
Well, you've been following. Is he usually correct, or is he like kind of like just like throwing out ideas that end up being like totally off?
I pay no attention to his like stock trading picks, so I can't verify that. But I do know, like just like his name of that blog is makes so much sense, right? It's just like the baseball movie Moneyball, right? He found an indicator that he's able to isolate, whether it's true or not. I mean, nobody knows, but it's just something nice to watch.
That's true.
I believe that before talking to him, I might have thought that the 2 and the 10-year inverse, and here comes a recession 6 months later. But he said it was like, well, yeah, that's just a mathematical thing where, yeah, you're just hit a plateau. It doesn't mean it's going to go up or down. It's just you're at a plateau. You're at a pivot point. We don't know which way you're going to go. So I don't think he said that it was going to go up or down regardless, but an outside stimulus like a Trump China trade or whatever can definitely send you in the right direction.
It's true.
I don't know. What is your guys' thoughts and your guys' crystal balls?
I mean, I think the party's got to end sometime. Party's been great so far, but at some point the party's got to end, and there's got to be like a correction. So.
Right. I mean, the counterpoint is that you don't have crazy lending anymore. It's still hard to get a loan, and from 2009 to 2015 was just like a super slow recovery. So maybe you can even chop that off and just say it was doing nothing. So maybe the real bull market is like from 2000. I think I really started 2012. So it's only been, if you go from 2012 to 19, that's only 7 years.
That's true.
But
we'll find out.
Yeah, we'll find out. But I do know like San Francisco, Seattle, that's been kind of on the decline the last year.
Yeah, Dallas is like that too. The market's kind of overheated here in Dallas. A lot of the commercial real estate guys are trying to get rid of their land and their holdings. So.
Yeah. I watched a video by Ken McElroy the other day. My buddy sent it to me. And Ken McElroy is saying, well, yeah, Dallas is pretty much overheated. It's over that cycle. So he has this chart where it's like a market cycle. He puts all these like markets somewhere on that curve.
Yeah. Yeah, a lot of the real estate guys are selling their residential holdings and their commercial holdings.
Yeah. I mean, one thing that I noticed that me and my other apartment investors were kind of split on is this one camp, and this is where I kind of am. Like I like Class C or tertiary markets, Class B and C still, but these markets that you've never really heard of, that they have better cash flow, right? Because in my opinion, when a storm comes, I want to be having cash flow. So maybe cash flow is 8%. So in a recession, it goes down to 4. Well, it's better than being in a primary market or luxury apartments. But another camp is like, well, we think that those tertiary markets, those cap rates have artificially gone up. And in a recession, those cap rates will kind of backtrack. And maybe it's better that we hold assets in like Phoenix, for example, like a stronger, more secondary, primary market. You just hold better assets. You don't cash flow as much, but it's a better play in terms of you just have a better asset. Whether it's just a stronger market or a newer property. I don't know what's better, right? Like it's kind of like, would you rather have these non-performing notes like HP that you have a lot of wiggle room, or would you be rather, but that's all bad paper. That's all non-performing stuff. Or would you rather have good performing assets, but you're barely making anything? I don't know.
I see. Yeah, I don't know either. So I'm kind of new to the game. So, you've got more experience than most of us.
Any other open discussion things before we kind of just go around the group and just talk about what you're up to, and then maybe we'll do some more breakouts.
I guess, how many people here are looking at mobile home parks? And is that just really lame?
Dave's a resident expert on mobile home parks. He was actually
Okay.
Yeah, I heard that mobile home parks are very much better than residential in terms of cost of acquisition and then cash flow. So.
How long have you been working with those?
I haven't. I've talked to people who've done it. But like, if Dave can chime in, if he's interested in chiming in.
Hey, the National Stadium is right about near where I live, and you can hear the fireworks in the background. Anyways, I've been doing mobile home parks for several years, and it's basically the cash flow paradise up until Kevin Bupp and and those folks basically started made everyone aware of it. Yeah. So in the last couple of years, it's been harder to find better deals. But when I was doing the game 4, 5, 6 years ago, you could find return on 30% ROI. IRR 30% cash flow easily. So. So yeah, it's gone down. The cap rates have gone down, but you can still, especially when you're in less than 50 pads, there's still great deals to be had. But when you get to 50 plus pads, then you're getting a lot of the institutional money now is flowing into those, because they've, this has been going on now for 2 or 3 years of the bigger places. But obviously there's still gems to be had, especially if you're doing cold calling and trying to find the mom and pop, places that are trying to retire and stuff.
And then under 50, you mentioned under 50 units. Is there there's any issues with scalability at that level?
What was your question?
I know with regular multifamily homes, under a certain amount of units, it's hard to get professional management in there.
Correct. If you do less than 30, it's going to be you have to do self-managed usually. So that's why the sweet spot is usually 30 to 80 pads, because then that way you can get at least a professional manager in there, and it's still under, without having to go. It's usually going to be under $1 million, so you could probably do it yourself without having to do like a group crowdfunding type of thing. But yeah, but yeah, that's been my, at least the last couple of years, ever since most of the real estate investors have moved from apartment buildings to mobile home parks. Now it's even harder to find those types of deals where you're getting really good cash flow because the cap rates have been going down. So you have to really do what Lane's doing is, trying to find the mom and pop deal still. But I mean, that's what everyone's doing. So
Yeah,
it's the competition. So.
Yeah, I mean, my thought is, like, I agree with what you're saying, Dave, but it's like 12 times as more competitive in multifamily, and why I come up with that number.
Yeah, all right, they're both competitive now. So I mean, it's just it's I guess I got kind of I mean, back in like 2008, obviously everyone was kind of loving life. So yeah, you just gotta adapt.
Yeah, I mean, I'm just thinking like there's so many multifamily gurus teaching this stuff, and I see so many like rando syndicators like syndicating random student housing deals or Florida deals that are just underwritten ridiculously, like 3% rent increases a year. The reversion cap is the same. They're paying cash flow day one from raised equity, and that's a Ponzi scheme. So there's like all this shady stuff kind of happening. I don't know. I don't know if it's like that in mobile homes because I don't understand those type of nuances. Like I know apartments, but all I know is like I'm like 90% in multifamily or single family homes, and I don't think that's a smart idea, even though that's kind of like my wheelhouse. That's like my thought, what I'm doing.
Yeah, the friends I have who do, or the people I know who do mobile housing, mobile homes, at least the ones in Dallas and Fort Worth, they were getting them for really wealthy people who wanted an extra home, so they put their horses there. So almost all of them were built around like these really like luxury mobile homes, so that these guys can just like have a weekend retreat with their horse, so they can tie their horse to something and ride their horse around. So it's just kind of interesting. Yeah, I have one friend who's got like 12 homes, just like 12 homes, 20 homes, and just for wealthy people to have a escape to put their horses there, So it's kind of interesting.
Yeah, I heard that depreciation is stronger on multi or mobile homes than multifamily. I haven't seen that. I need to see the K1s come back, but I think you can cost segregate a lot of the equipment out more on that stuff. But I mean, I've been seeing on the K1s I've been getting back. I mean, they've been ranging anywhere from like 70 to like 80 something % back on what I put in year one. I mean, I heard some guys getting like 100% back. That's kind of crazy, but older properties seem to get more depreciation back because it has a shorter usable life. Whereas like that Majors deal I did that was built 2018, we didn't get very much depreciation back because that thing should be able to last forever. So the denominator, which you divided the value by how many years, there's a lot of years left. So that was the justification I got back from the CPA.
So is this what you're doing in Little Rock and Huntsville? Is looking at mobile home parks?
No, those two are apartments. So it's like a little 50 unit and 100 unit.
Well, those are also great areas for mobile home parks.
Yeah, so the mobile home park I'm gonna check out is like down south in Mobile, Alabama. I don't know what the city is called, but that's the biggest city next to there. So yeah, if you guys want to come along, make sure that nobody mugs me.
Are you going to be the operator for that if you find one?
No, I'm not. But I'm going to select the assets. So I'm probably going to team up with the guys at Four Peaks, Mike and Andrew. So you talk about all these guys like Kevin Bubb, Ryan from Elevation, all these other guys. I mean, like my rule is like I only work with people I know, like, or trust. So Mike and Andrew, we kind of came from the same group a few years back. So I trust them, I like them, and they're definitely like growing their business. I mean, I call them like the Damon Lillard of the NBA right now. All these other
So how
guys.
many mobile home parks do they have in their portfolio?
I don't know, but I know they have at least like dozen or two.
Wow.
Andrew's kind of the numbers guy, but Mike's really the operator. He's the construction background part of that group. But what I'm putting together is like a mobile home park fund, and what I want it to be is like more of a cash flow play, so stabilize assets, like the complete opposite of like what Moberly was, where it was like no cash flow for a year or two, but then explosive higher total returns, right? But what I'm noticing, the what I want is like people want instant feedback. They want cash flow day one, and they're willing to take a little bit less total return. So that's what I'm trying to create. Again, but I got to do a survey. I got to send out a survey to everybody and see what exactly they want.
So Four Peaks doesn't already have a fund because most of these people already have funds. I know Kevin Buff has a fund and all these other places have funds.
Yeah, so I'm gonna make it non-accredited. That's what I'm fighting for.
Oh, okay.
And they're right now they have like another fund, but it's more value add mix. But I have to ask you guys and all the investors, what do you guys want? Do you guys want value add mix, which is going to be a little bit more risky, a little less cash flow? You have to wait a couple quarters for cash flow probably, and maybe a little bit higher returns, total returns, or do you want, low double digits cash flow starting from the get-go, and that just kind of steadily increases as the years go by, right? It's two different business plans, right? And as a park comes up, now those parks get put into certain funds based on their risk profile. So I think people want, to pair with all their apartment syndications, which are, there's cash flow, but it's kind of a forced appreciation play that, especially a lot of the new people coming in, that they get like sort of like an AHP is in a way. There's a straight return, but it's an equity play. You get part of the upside.
Hey, Lane, you stated that it's a syndicator and they have a return that's immediately cash flows like in the first 3 months, like every month. That it's a Ponzi scheme. You've never seen a syndicator who was able to cash flow things that they bought and flipped or value added within the first month or two.
So what a lot of these guys will do is like they'll over raise on the capital. So they'll raise like $250,000 as extra cash reserves.
Okay.
And then they'll start to pay out all the investors 2% a year or 2% a quarter. Not from the money not from what the property is making, but from that stashed away money. You cannot pay distributions off of that. It needs to be stuff that property is actually making. Most investors are too stupid to know the difference. They don't care. They just want money back. But it's fine if things go well. But as soon as things get a little rocky, that's the kind of stuff that comes tumbling to the ground.
I see.
So I think we did a deal like that. I think you were in that deal, Dave. Remember, they called it like a convertible note. So technically that was legal, I think, the way they did it, where they paid people back like a certain percentage.
Yeah, the RV park deal. Yeah.
Yeah,
Yeah, I'm still in that deal. It's still going on.
yeah.
And I still have not really. I mean, he stopped sending updates like last October.
Oh
I
no,
haven't gotten.
that deal. Okay, that deal. I'm in that deal too.
Oh.
Yeah, that one is fine. The other one was like the medical facility deal.
Oh, that one. Yeah, I was in that one.
Yeah, but you got in as just a debt investor in the initial. There was like a phase 1 and then phase 2. You
Yeah, I
got
got in.
you got
I tried.
out. You didn't go into phase 2, did you?
No, no.
Okay. That phase 2, what they did was because they were actually building the property, they paid out investors sort of like a dividend, and that's what I'm talking about. Like that, obviously the place isn't open for business. How can they be paying distributions out? But they made it legal by structuring it like a convertible note or whatever.
So how do the investors think about phase 2 then? They don't. Are they happy about that?
Well, they don't care. Most investors don't care, right?
Oh.
But just know that in times of trouble, now you're already behind. You already just blew through, and then it I think it hurts your top. You're basically borrowing money to pay your returns ahead of time.
Gotcha.
If that makes sense.
Have any of you guys heard of this syndicated group called Enzo?
Yeah, I met him.
It's like a big group of 4 people. The group's name is Enzo. So
Yeah, VT and all these other guys. I mean, they're new.
yeah, they're new.
Yeah.
So, but they're paying dividends monthly right from the beginning. So that's why I was asking.
Oh, well, there you go.
Yeah.
So here's how you check that. Like, you ask what is the cash reserves that are being raised for the deal, and you're trying to ask in a non like forward way, like, hey guys, are you guys raising extra capital to pay us out? I mean, it's not to say that they're going to like run a real Ponzi scheme where they're going to just take that $250,000 to pay you guys out for 6 quarters, and then in the 3rd quarter make an exit out of the country. I don't think these guys are going to do that. But technically, like if the property goes back, now they're already behind.
I see.
And what I see is doing that. That's a way of like, it's a way of like taking steroids with your investor base, because now it starts to get people excited and gets the buzz going, but it's not real success. I don't know. Roger, you ever seen this? I'm not in any deals like this where they're doing it, because usually they're underwriting the deal really crazy.
Yeah, it usually throws me off when they say something like, we're going to raise somewhere between 3 million and 3.5. When there's a huge gap like that. I never really thought too much about it until now that you brought it up. But I'm going to go back and look and see if any of my deals were set up like that.
I don't, okay, so I think that's something different. That's like, that flexibility comes in, like if something comes up in the last week or 2 where the interest rate changes or whatever, or an extra fix comes up, like they can't get like those AC thing, the seller rejects that compromise or whatever.
Okay.
And then what that is like in the future, say the deal goes bad, right? Or they need more capital, right? Because a lot of times these deals, they go with thin cash reserves, as they should, because the investors who got in want that higher return based on, they want less investors to share the profits with. So, but that gives the general partnership the ability to like, all right, this deal's not going that great, and we want to save face and not tell our investors what's really happening. So we're going to go silently raise an extra 500 grand. And that allows them to do that without, telling the whole world, and then making a new, worst thing is making new PPM. Because you have to follow that PPM. So you can write that PPM as general as you want, or as wide range numbers wise as you can. So I think that's what's going on there.
Okay, so that they're not taking that and paying the first.
Yeah, most deals they have a big range on that thing,
Okay.
and that's just for flexibility. Any smart guy would do that.
Yeah. Yeah, usually if it's something where I don't understand where their numbers are coming from, I'll walk away. But most of the deals I went into, it was the other way where we were going to raise this much. We only raised this much, so your returns are better. And I never had a problem with that.
Well, it's
I
kind of
should.
like, like the analogy that I joke around a lot of people, other syndicators, is like, you see them closing a deal on Facebook, right? And they post the damn thing. And then everybody's in this big like circle jerk, congratulations, yay. But then a few of us are like, oh boy, they left that plane took off with like half a tank of gas,
Yeah.
And you're like, oh boy. And that's the scary thing about this private placement thing, and that's why it's important for you guys to talk with each other and build relationships, because like there's no website for this stuff.
Yeah.
Nobody knows. Like the plane takes off and heads across on the horizon, and nobody sees if it ever gets to the destination.
Yeah.
So what mistakes have you learned from in the deals that you started since you started the Hui group?
I would say the only deal that's actually struggling is the Des Moines deal. Roger in this one. I think, so here's the lesson learned. New operator, and I think it's just like the cost came up higher than what it was, and the absorption of the new tenants wasn't as what we thought it would be. We're not going to lose everybody's money. I don't think so, but it's just going to take longer. And that's, at the end of the day, there's an element to luck to this, right? Because you perform a $75 rent increase, certainly nothing more than 12% in year one. That's another catch that you should check. But you may get that, you may not. You may get something higher, which is great, but that's where the rubber meets the road on this stuff.
Mm-hmm.
I was actually talking to David about this a few weeks ago, but I'm in like 8 different deals, and the 2 that are underperforming are the ones with the least amount of units. So that was just one thing I noticed after investing for 2 years.
Yeah, it's unforgiving for sure.
Yeah.
But I'm talking with some of the guys I'm working with, and you're gonna see like this Huntsville deal and Little Rock deal are kind of those examples. Well, not the Huntsville, not the Little Rock one, but you guys all signed this non-disclosure thing, so hopefully you don't repeat what I say here. But the bigger deals, they require a celebrity to be on that page that, and you guys know who these celebrities are, so I'm not going to repeat their names, but these guys take a big freaking cut of the general partnership. Big freaking cut. Ken, I kind of was laughing at there in the beginning there where you're eating chips.
Yeah.
Because one of these guys was eating chips in one of these webinars. He didn't do anything.
Whiskey? A little whiskey here too?
No, he wasn't drinking whiskey, but he was eating chips during the whole freaking webinar. And I don't know, Roger, do you see that one?
No, I wasn't watching that.
No. But they're taking a huge cut. And it's just not like, I get it. I mean, it'd be nice if I had that type of gravitational pull. I guess anybody would do the same thing. But to get those deals done, you need the net worth and liquidity. And now you can't just rely on like one person to go raise $3 million. You need to raise $5 to $10 million. Now you're talking about serious money there. So you're going to need the celebrity to kind of pull the forces together. So I agree with you, Roger, except if there's a celebrity taking a big cut, because they're taking it from the LPs.
Yeah.
And they're taking it where it should deservingly go to the real general partners who are the boots on the ground.
Yeah. Do you see any value in those celebrities because maybe they don't have as long of a track record, generally they do, but the fact that they have more to lose, they're more established, they're going to be more selective with the deals they take. They have more, not at all. Like,
You know how to run the numbers. You just go look for yourself.
yeah,
Get the pianos and rent for some of these deals, and show me what you find. Because I
No.
ran a couple of them. Like, whoa, like this is not smart.
yeah, I agree. Some of them, the numbers don't make sense, but the ones that do, I think when you're comparing the same asset, in the beginning, I liked having some money with those larger celebrity syndicators for the reason that they just see more deals and they get more. I felt like they had people working harder for them to put those deals together, as opposed to somebody that's just up and coming. Of course, there's they're going to take their cut, but that was one of the things I wanted to spread my money in between.
Yeah, no, I think you have a valid point. Like my counterpoint is a lot of these guys are, there's a coaching mentorship relationship. So there's a conflict of interest. They're going to go into your deal because they have to, right? Because that's their business. You go under their program, they need to have successful people, right?
Yeah.
I mean, I guess I would do the same thing, right? Like if you did something like a website thing, Roger, yeah, I'd jump on board, and if I believed in it.
Yeah.
But there is a little bit conflict of interest. So not to say that it's not every case, right? Because some of these deals are actually pretty good. But you have to decode the code to know which ones are which.
Yeah. You think the celebrities have an easier time selling a distressed property if it got to that point?
What do you mean distress? Like,
I feel like if when it comes time to sell, if you don't have that large following and you want to sell a property, you're pretty much stuck with what the market gives you. But when you have that celebrity status, you can throw it, to your students, say this is my deal. Of course, it's a good deal. And they're gonna have
but everything goes to the broker, right? For the most part.
Okay, yeah.
That's what the broker's job is, to go sell it.
Yeah.
I think the only value that they bring is the capital raising part.
Okay.
So that the attitude I have is like, well, if I like a deal and I'm gonna go in and I can bring $3 million with me, I tell these guys, well, screw these guys that aren't gonna do anything, eat chips on your webinar.
Yeah.
Let's just go do it ourselves and make it an 85-15 split or whatever.
Yeah.
But I don't know. I do think what you're saying is valid, right? Like, I think I'm working on like a passive investor scorecard, and that was one thing that somebody brought up was, well, this guy has a podcast. He's a big like celebrity. At least he's not going to run off with my money. I'm like, yeah, you're right. That is part of it. I think we got time for like one more topic. So what's going to happen here at the top of the hour, regular people from the rest of the Simple Passive Cash Flow Freebie Nation is going to be jumping on this call. And then I'm going to be running through the quarterly investor letter, all the news articles and thoughts that I've been having and stuff I've been up to personally at the top of the hour. But for the last like 5 or 15 minutes, if you guys got one more topic, we can talk about that. But I was just going to throw you guys into a breakout room to kind of connect with each other a little bit better. And then we'll roll into that investor.
I have a quick question. Do you think you're going to ever move into being an operator at some point, or do you like just connecting investors together at this point?
Yeah, I don't think I'll ever be an operator.
Yeah, that's what I thought.
I think if anything, what I would like to start is like finding deals and then pulling the operator in, because finding the deal is a big part of adding value to the general partnership. Because I get at these guys all the time. It's like, oh, I want to be in the general partnership. Like, well, no shit, you want to be part of the general partnership. You get paid more, but like you don't do anything.
Right.
So how do you get in the general partnership? You find the deal, you do the hard work, or you bring in a lot of money. So you can also, if you're a high net worth guy, you can also sign on the debt, but I wouldn't really recommend that. I think that's not a, I don't know, you got to really trust who you're working with. But I think as I examine those three options, I think maybe I can build some systems and find deals and lock those deals up.
Right.
And what's nice about this apartment investing network is it is sort of a, like, you know, it's a cordial group of people where it's not like someone is going to steal a deal from you. So you can kind of shop it around.
Yeah.
I was going to ask about your internet marketing plans. I know you were going to take on a project. Is this the right group to talk about that with, or you want to save that for another time?
Well, I like to make podcasts and stuff like that, and I like to do that kind of stuff. And I just thought about using that skill, but maybe team up with somebody who is running some kind of a business.
Yeah. Any progress with that, or is it still kind of just brainstorming?
No, I'm waiting for you to bring me a deal.
I've been working on it. Thinking I got some potential, but I don't like throwing random ideas out there. I want to be, you know, pretty sure about it. But
I'm going to that Rhodium conference in Las Vegas.
I'll be there. Yeah.
Yeah, you're going?
I'll be living down there at that time, so that'll be
super.
Yeah.
Okay, he let you in that mastermind?
No, am I supposed to sign up? I know they had
yeah, you gotta have an intro call with him.
Okay. Is that the one with the Shark Tank guy, Mr. Wonderful?
No, that's Freedom Fest.
Okay, I'm thinking of something else then.
Yeah, go look it up, and then you can use me as a reference.
Okay.
But he wants to talk with you first before he lets you in. Okay. But if you guys don't know, Roger is like the whiz kid as like Amazon stuff, but like for that basically you want to buy a website, and Amazon is just kind of one part of it. So you have to pull all these, like an internet marketer or content creator, and you're just trying to improve that website, just like you're buying a distressed single family home. You're adding value to it. You're getting the income up. It's nice that it's cash flowing. So this is something that's cool to syndicate. It's very fragmented, and but it's also transparent, right? That's a nice thing. You can verify a lot of the numbers.
Yeah.
You know, children of the internet. What we are.
The Belize thing, I thought you said you already bought into that a while ago. So you're just going to get new investors involved, or?
No, I actually haven't done the Belize one. The Belize is the chocolate one. The Panama is the coffee.
Oh,
so
okay. Yeah, I'm in both. I did the cacao and the coffee beans. I'm in the Panama and Belize.
Okay.
I still haven't gotten my deed from either of them. It's now been 2 years. March 2017, I bought into those.
Yeah, I told Darren I don't need a deed. I trust him because I'm using a health savings account, which is impossible for them to deed it in that manner.
Okay.
But yeah, I mean, I would. It's good fun, that trip, for sure. I am maybe not as bullish in the chocolate as I am the coffee. Because my theory, which is not a very good theory, it's just like, well, in a recession, people are going to drink their coffee or chocolate, and coffee is like one of the most scientifically studied thing ever, where chocolates are more discretionary.
Yeah, but there's so many American holidays, it's insane, you know?
Yeah.
You got Valentine's Day, you got Easter candy, Halloween candy, I mean, it's just nonstop sugar all year round in America.
Yeah. So you go from like Godiva to like Hershey's. Your problem solved. But you know what? If you remember in like 2009, 10, coffee actually went up because people couldn't afford luxuries. They couldn't go to buy stuff for vacations, but their one glimmer of hope and happiness in their life was that $5 cup of coffee. And
It's true.
So yeah, I'm gonna send you, if you guys don't have anything else, I'm gonna send you guys off to breakouts, and then I'll be back to do like probably the investor quarterly for about half an hour. And then you guys are welcome to type in messages or ask questions throughout. So, and then, so let me send you off into breakout room land here.
Hey, Lane.
Yeah, go ahead.
Hey, are you going to record the quarterly meeting and put it on your YouTube channel, or is it kind of?
Yeah, I'll probably record that one.
Okay, just wondering because we have a meeting we have to go to. It's like 10 o'clock our time right now. So.
Okay.
Yeah, it's 11 our time, so my time.
Yeah.
Try to make these early for you guys. But there's a lot of people that. Let me recreate these. 1, 2. Okay, there you guys go. Click accept.